Hi Bernhard, how are you today?
Alex, I'm great. It's hot in Zurich, but I have the AC running here in the office, so all good. Weather is nice too, but was looking very much forward to our convo today, talking
Nice.
everything insurance and risk. Yeah, and you? How are you?
Good, good. Busy day today. I today spoke to South African risk community on the 2026-27 annual risk report that IRMSA, the Institute of Risk Management for South Africa, just published. And I was trying to make this report practical and kind of connected to what I do in my day-to-day job, and I decided to focus on like three messages. Message number one is I think risk doesn't get the respect it deserves. And it sounds fancy, but what I actually mean is that if we kind of claim to be risk professionals, then we should feel passionate about uncertainty, volatility, and risk, and we should really not stop, but nudge and influence others in the organization when they clearly and blatantly ignore risk. Like we are almost like custodians of risk knowledge, and then whoever is making a choice or making a commitment within the organization, and if they completely disregard the risk which we are custodian of, I feel that it's kind of our obligation to nudge them in the right direction, to inform them, to give them additional insights on what are the downside scenarios, what are the most uncertain assumptions, what are some of the scenarios that they need to consider before they kind of settle on the choice. What are the the most stressed inputs into the calculation. So that was like the first message, is that I don't think risk gets enough respect in the corporate world, because
Why do you think that is? Why do you think that is?
Well, there everywhere I look, from budgeting and business planning, you can see how the finance department and the operations department kind of set up the forecasts and the assumptions that they use. And it's always like a single scenario. There's like the base case scenario, and then sometimes there are multiple scenarios and they kind of navigate between one or two scenarios. But in reality, every assumption that they use is actually a range. It's a distribution. The connection between the risk, between the different assumptions, also could be highly positive or highly negative, depending on what kind of risks happen. But then, even closer to our world, assuming for a second that the risk person is a separate person from the insurance person, and then if you were to visit the insurance team office where they sit, like if you walk to their desk and ask them how they're renewing the next PDBI policy, how do they determine the limit, and how come they're only insuring PD and not BI, and where's the deductible coming from? And what you'll find, like what you'll conclude most of the time, is that most of those important choices have no connection kind of to the underlying risk. Like there's no risk analysis that led to a conclusion. It's usually a history or common practice or like broker recommendation, or this is what we've done last year. And same in procurement. If you look deep enough into the process, you would see that how the company decides on which vendor to select, who gives the better price versus the quality. They consider some of the risks, like for example, they would consider the quality. They may even consider, like they kind of do pretty well with all the compliance risks, the sanctions, the tax liabilities, the court cases, the bankruptcy proceedings, like all of the compliance stuff. But then when you try to kind of understand, how do you incorporate operational exposures? Like what if we need more diesel or less diesel? What if the diesel price skyrockets and we need to go electrical? Like where are the different optionalities? What if our equipment requires like a different grade of raw material, that different purity or something? Like all of those things are often excluded or ignored in the decision making. So that kind of brings me to the conclusion that risk doesn't really get a lot of respect.
Yeah, exactly. And I think like that. I'm still always surprised when I hear that, right, and how it works in companies. But I want to just bring an anecdote, right? One of the by far biggest infrastructure providers in Europe, absolutely crucial for one of the countries in Europe. I cannot name the country actually, because you would directly know, like the people would know who that is, etc. But they are actually like, there was the crisis on the energy, right, and they were figuring out, hey, we have to now directly preempt or directly buy for the next 3 years, right, energy and stuff like that. And there was this one risk manager that actually ran the analysis with AI, right, like actually created like certain projections, etc., how this could actually affect, and also like the overall operations and stuff like that, and created in a way, and then actually was able to communicate that to the crisis management of the overall company, but then also overall the board and everyone. But it was like this person that actually like was constantly being pushy about it, right, and making himself in that case super valuable to the organization, taking it up, but then getting pushback again from other areas where they say, no, but you're stepping on my turf now. You like risk management, you don't know anything about energy market pricing and stuff like that and so on. And then he would get pushback, right? But still the board super loved it, right? So I think like, as you mentioned, it's a little bit like I think like a respect thing, but the other thing also like is people, you have to break this kind of like I would say like view of the risk management function that is just like compliance or whatsoever. You have to force it onto them, show them the value, constantly pounding against the wall until you take it down, right? That's a little bit like how I saw that, and it always surprises me because, hey, is it a compliance function, or do we want to provide value, right? Do we want to fill like some registers, or do we actually want to quantify the risk rate and help the company be more resilient and make better business?
Yeah. And this is one of the things that fascinate me as well, because if you were to walk through the FERMA conference of all the like European insurance and risk managers, and if you were to randomly ask 100 risk managers, I'd suspect 100 of them would say that their goal is to add value, support decisions, and improve planning and forecasting and budgeting and performance management within the organization. So there seems to be kind of a theoretical consensus that this is the right thing to do. And then if you were to ask them like a second question, okay, like what do you actually do? Like what's the methodology, the techniques? Like what was the last thing you quantified? And then less than 1%, I'd suspect, have actually done anything to be in the position to support the decisions that they aspire to support. And one of the reasons is kind of, I use the word respect loosely because like I don't actually mean respect. I just mean like it doesn't get enough attention or visibility. Because one of the reasons why people don't do a lot of like quantitative proper risk analysis is because you do have to push it. Like nobody is inviting you unless you are in a very lucky position and with a very rare like CFO and CEO, which I mean, I kind of have been lucky in the last 2 places. I mean, even 3 places I worked at where the management asks for the risk analysis before a decision is made. But most of the time, nobody's asking, and you have to constantly kind of push and go. But wait, you can't, make a decision based on just NPV calculation because it's a single value estimate. It's not even P80. You have to do the proper stress testing of the assumptions first. You shouldn't approve this project completion date. You shouldn't buy the limit for the insurance just because the broker recommended it, or just because the broker engineering or underwriter engineering report put it as a maximum probable, some sort of probable loss scenario. There's more to it. You constantly have to push because business doesn't recognize that the values is there. Mm-hmm. And I think that's my first point that I was trying to make today, is that the reality is risk management doesn't have the respect yet to be requested. So it has to be kind of almost like not even enforced, but nudged onto the table.
Exactly, and they have an exciting challenge, huh? So you obviously right now, like you had actually like a CFO that you would actually be able to bring stuff, right? Like, and that would appreciate heavily like your work and the all risk management, right? Now let's assume, let's just like think Alex gets dropped into an organization, very like, I don't know, top-down driven, etc. Risk management was always seen like a compliance function, right? Like, how would you approach it?
Well, so first, and I think this is kind of an important part of the answer. It's not a cop-out, but it's an important answer. It is highly unlikely that I would join a company like that.
Yes, that's why we make it hypothetical.
Yeah. So I
tricked you.
Been very, very selective in joining companies to work, because I do not want that to happen. Like, I've had that happen to me in the past, and I do not want to repeat that. Like, it's just such a pain. However, when I was working for a government sovereign fund, and it was exactly that situation where like nobody wants to see you, like nobody's excited about risk. They all see risk as a compliance. And it's a matter of just trial and error of different messaging. And so I found like 2 amazing insights by kind of just brute force trialing different approaches. Number one was, and we even had a joke with the CFO, we were implementing risk management not with the executives, but despite the executives. So every single executive except CEO and CFO were like violently against it, because they were all investment professionals. They're like, oh, we are VC fund and we are PE fund and we're like leveraged buyout. So like we understand risk, we understand investment. Like we are shit hot. And the first thing that worked amazingly well is I found that the executives don't care, but their direct reports, the investment directors do. Mm-hmm. And sometimes the investment managers or the associates do. And not all the investment directors, like some investment directors are just arrogant beyond human, salvation. They're just like pure evil arrogance of investment world. And once you find like-minded individuals 1 level below or 2 levels below the decision makers, and once you kind of integrate into all the materials and all the presentations and into the methodologies, the executives don't care enough to block it or stop it. They just accept it. Like once somebody else does it below them and they see the result, like they see the risk analysis, it just stays there. Like nobody's actively going to go like, no, please delete risk analysis from our decision. Like nobody's, that against it. They just can't be bothered doing it themselves. But if somebody else is doing it, perfect. So that worked amazingly well. I found plenty of directors that saw their own personal benefit in disclosing the risks and making risk analysis transparent. and showing how understanding risks better led to better deal structures and deal valuations. So that worked pretty well. And the second one was I had this wonderful message to all of the directors. I was saying, you can talk to me about risks today, or you can talk to internal audit in 6 months, or you can talk to external audit in a year, or you can talk to the prosecution office because it was government money in a year and a half. Entirely your choice. I couldn't care less. You do you. Which is also, it was ironic at the time. It wasn't actually ironic because some of the investment directors are now in jail. So not everybody kind of learns the lesson.
Not everybody took like the first step. They waited all the way through.
Yeah, exactly. So it's a matter of, even in kind of pure compliance mindset, complete ignorance and arrogance about risk, there's still certain keys that you can find to kind of to unlock people, and that works. We made it work. I think the big kind of the final lesson on that was, everybody pushes back on risk management until the message of risk analysis is consistent with their own internal fears. Like for example, once many years ago, my analysis concluded that the fund will go bankrupt within 5 years unless the investment strategy changed quite significantly. And that's a career-ending conclusion, because you bring to all the executives that have been making all of these investment decisions, you basically say, we've simulated 10,000 simulations, and there's 99% probability it's going to fail. The whole company is going to fail. And normally, that would be a scary message to bring. But this time it absolutely wasn't, because quite a few executives felt uneasy about the path that the company was taking. So it was very timely and independent kind of reinforcement of what they were probably privately saying to the CEO as well. So I remember when I was presenting
which they could not quantify initially, right? They just had a feeling, but they couldn't quantify it themselves.
They didn't. They probably could have, but they just didn't quantify, didn't make an effort to quantify. So they were grateful for somebody making an effort to quantify it, bring it to the table, kind of be the messenger. And as soon as I kind of showed my analysis with all the caveats and the probabilities and missing assumptions and so on, they just jumped on it, going yes, exactly, I told you, this is such a good analysis. Nobody questions your methodology when you are saying the same thing that they're thinking. They only if you're saying something opposite, they go oh, well, what distribution did you use here? How did you quantify? Should it be Monte Carlo?
What is the source data
maybe
here?
Some other?
Where did you get that from?
Exactly. South African risk community, the first point I was saying, that risk management doesn't get enough respect, because it should be in every single process in some shape or form. But the reality is, it just isn't. That's a fact. Risk management is not properly applied where and when it should be applied. For example, purchasing insurance, or I think the world favorite right now, which amazes me, is captives. I bet if I was to decompose and analyze the logic and the rationale and the methodology that most European companies were using to set up their captives, it would be completely economically unjustified, and probably not an amazing form of risk management. Just because most of these kind of choices and decisions have been made disconnected from the risk person in the room.
Exactly, disconnected from the risk. disconnected probably what is actually your cost of capital, right? Compared, can you even compete directly with the insurer and reinsurer on that? Yeah, so quite an interesting one, 100%. And then they have all of these different companies that help you set up the captives and make a whole business around it and make it sound perfect for you, right? Like that you actually do it, and then in the end, like it's just like a vehicle to funnel money.
Yeah, well, so like in my mind, and one day we will investigate captives in a little bit more detail, and the findings I think will be interesting. But something just doesn't add up for a solution which is so technically difficult and is a form of capital allocation with pretty kind of thin margins and very long-term payout structure. For something that is kind of that complicated from a risk management point of view, the volume of captives created is just strange. Like it's just way too much excitement about something that is like pretty high risk in terms of the setup, the compliance, and the capital efficiency.
100%. And like you say, like, and just that would be just like a feeling from my side. And I'm throwing numbers out now. If you look like 10 captives set up, like probably 1 or 2 would make sense to set up. The other ones is just like a little bit like more because it's trendy, right? Like, and because we think like that's a great idea. And I definitely again want to second that, right? If you set this thing up and if you do not have like a proper view of your risk, if you have not done like your homework and if you have not built the foundations, etc., how are you going to, what is your thinking around that you're going to be the better capital allocator, right, around that, instead of just like using insurance in a classic way?
Well, yeah, exactly. And it's like we pick up on so many interesting points, and I think each one deserves like unpacking in due time. But I have the same with parametrics.
Mm-hmm.
Like
that's a tough one.
If you can't, well, actually, let me rephrase that. Like they're going like, oh, we need a parametric solution, and I know the insurance strategy, like I know the asset, and I'm going, but you haven't even figured out PDBI yet. Like I know the way you structured the policy is very inefficient compared to what we are doing. For example, you haven't even quantified the PDBI world yet, like the plain vanilla product, and yet you're going like, oh, we're not going to try to make the plain vanilla product better. We're just going to jump into something that is so much more complicated. Instead of trying to figure out the kind of the easy one, we will find the solution elsewhere, which is way more, so it requires way more sophisticated math.
But I kind of understand it because they're outsourcing the legwork to the client, right, to the insured. Because in the end, like if you buy a parametric insurance, right, like the client has to figure out themselves, like at which point does that make sense for me, right? So in the end, they can just like say, yeah, we're providing this parametric solution for you. But actually the client still have to figure out and build the whole bridge of quantification, right? So it's kind of like just them saying like, okay, hey, we have it, but you have to work towards that and figure it out for yourself. That's a little bit my feeling around it. I would
but that's exactly what I'm saying. No, but that's exactly what I'm saying. I'm looking at this from a client perspective.
Mm-hmm.
I'm saying you as the client haven't quantified PDBI, which is a plain vanilla common product, a commodity.
Yeah. Gotcha.
And then you're saying, I will not quantify the commodity. Instead, I will jump into this exotic solution. But then to myself, I'm going, but exotic solution requires even more sophisticated quantification. And if you can't even quantify PDBI, how are you quantifying the other one? And they're not. That's the point I'm trying to make, is that somebody is jumping for the exotic before they figured out PDBI, because I bet, again, like same story, I bet out of 10 companies that went for an exotic parametric solution, they probably could have achieved a better performance with the plain vanilla PDBI product if only they've done the quantification properly.
100%. No, I'm definitely with you there. It's just like, just not doing the homework. And we have a problem around that because I don't see like a lot of clients or insureds there there are actually like when we talk to clients, right? Like the ones that actually get it, right? That's the ones that we also want to work at ScyAI and stuff like that. But there's others that just like think everything is okay and it's fine like that. And it's not, guys. It's not. It's definitely not.
Yeah. Well, so that brings me to the second and third message that I was sharing today with the risk community. The second message was that if risk was to kind of get the respect it deserves, then the second point was that, well, risk is never free. And that means you have to price it in. Like you have to price it in into the maintenance program, you have to price it in into the CapEx program, you have to price it in into environmental sustainability program and licensing timing. You have to, like, every uncertainty, once you start looking at it, once you start acknowledging that uncertainty exists, it will actually make your deadlines and your budgets and your forecasts bigger and longer. Like that's almost like a given. If you budget for something to be completed, then once you understand all the different uncertainties, you will come to a realization that you should probably allocate more budget because there is some uncertainty contingency that is required. Like you want to add some buffer to the original plan because most of the original plans, they ignore risk. And this happened to us in insurance, for example. We thought we needed $1 billion of coverage on marine cargo. Yeah. It turns out once we quantified the risk, we actually needed $3 billion of coverage. Same with chemical plants. We thought we needed 250 or 200 million limit dollars, and it actually turns out we need 1,200,000,000. So like plus $1 billion of coverage, and that means, you know, you used to buy 200 limit insurance, and now you need 1.2 billion limit insurance. That has implications because no single insurer has the capacity. So you have to like do a tower, or you have to do co-insurance, or you have to like reinsure a bigger portion, and the price will of course change because you're buying a lot more. And proper understanding of risk comes with the price, but that price is still significantly lower than continuing to ignore the risk. And that's an important realization that we have to accept, is once you understand what the risks are, your price may change. And I mean, then you have like different other points to make that once you understand the risk exposure, you also better understand the risk quality, and you can actually sell that risk quality, because when our marine cargo went from 1 billion to 3 billion, our price actually decreased. Our total cost of insurance actually decreased because we were, along the way, we said, oh, we need so much more insurance, but also we now understand what our quality of risk is, and our quality is so much better than what you thought it was last year. So we want a better price, and we found markets that were willing to buy our risk at a much lower rate than the previous insurer. So it doesn't mean that understanding risk always comes with a higher price, but the price will be different. And then in our case, it actually came with a lower price because it helped us, you know, argue our case with the risk quality. But that's an important point to realize, that risk is not free. Like, it's never free. Optionality. For example, you know, if you want to build a plant that can use 2 different reagents, because certain reagents have different supply chains, and you know, some of them may be dependent on the Middle East, and you know, if the war breaks out further, then it will become super expensive, and you want to build in some optionality. That optionality means the warehouse has to be designed in a way that can store both reagent 1 and reagent 2. And they may come in different shapes. Like one may come as a bulk, and the other one may come in big bags. And you actually need different pieces of equipment to be able to handle both. That will cost you extra money. But that optionality that it creates, then no matter what happens in the future, you can just switch between different reagents and save the delays and save a lot of money. So that's the second important message. And then the final third message was that once you appreciate the risk, once you price it in, the third message was, let me look it up because I forgot. Oh, yes, the most important one. The third message was that good risk management should be rewarded, meaning that insurance companies, banks, regulators, and internally, if somebody is showing evidence of good risk management, they should be rewarded. And we've been proving this all these years, that it is indeed true that if you're good at risk management and you show it to the key stakeholders and you prove that you're good at risk management, you get lower rates, you get better conditions, you get different regulatory treatment. So good risk management pays off. In my mind, like that's a settled debate. Like I am absolutely confident that good risk management pays off very quickly. But I think that's a message that the risk community needs to understand, because a lot of people in the risk community still think that risk is the invisible warrior of having the good insurance program, we prevented, and having the good risk mitigation and engineering recommendations plan, we prevented the fire. And so nobody sees the fire. But there's a lot of other rewards that are very tangible and very visible. So for example, if you invest in good fire protection, then your cost of insurance and your downtime in production and your quality of product will actually increase significantly, and the cost of insurance will reduce significantly. So you can actually convert that to almost like immediate, tangible, very physical savings.
Yeah, and I think you make a great point there. Like it should be rewarded, right? But just like these pieces for now, you implement additional risk controls, right? Let's say like better fire protection, etc. But the job then of the risk manager, if you really want to reap the rewards, cannot only be to implement them and make sure that we have them, but also to communicate them to the stakeholders, communicate them to the underwriters, through the brokers, communicate them to the board, etc., that they actually can reap the rewards of that too, right? I think that the job doesn't stop there. It really just continues from there, where you then actually also have to make that happen, like that you see the results, where it connects then further down the line, right?
Exactly. And we have a question on LinkedIn. This is just somebody who reposted it into YouTube, because we can't directly see LinkedIn questions in this system. How much risk management relies on manual checks, and what it would mean if it was automated. So, I mean, I think I have a very good story on that. In the past, I used to have 2 math PhDs, and we would spend months trying to analyze the sales data and the Incoterms data and the different engineering reports for physical assets. It would take a long time. And now with ScyAI, for example, it takes minutes for simpler tasks, and sometimes hours for something that used to take months in the past. So yeah, I mean, in the age of AI and fine-tuned, purpose-built tools, harnesses, it's we live in an amazing time. Which brings me to a question to you. How was your experience? I know you recently tried to do some analysis for a company.
I just wanted to mention that piece. Exactly.
Yeah.
Because you just mentioned, right? Like it helps you mount so much internally for insurance and risk management tasks, right? With the evidence, etc., just like creating things, etc. But then we also had like a huge critical infrastructure provider that was analyzing a potential acquisition of a North American energy company. And there, we and they were using ScyAI, right? And I think this is like the other side of the coin now, where we said like, hey, we want risk management actually to be a function that is valued. On the one hand side, like internally with the standard stuff, like having proper insurance management, having proper risk management, but then also supporting like the board, the executives, etc., in super high stakes decisions, like an acquisition. I mean, what is a better example of where risk management actually should provide quantified data and should actually be like one of the advisors on such a big deal that is so important for a company. And what we saw there was just amazing and astonishing, and I really loved it, because we literally created like in hours like a full digital twin of the acquisition target, which is a huge company, like with very, very difficult to capture assets, I would say. So think gas pipelines, think wells, think treatment plants and stuff like that.
Hundreds of wells.
Yeah, exactly. Yeah, it was like actually thousands. I'm not gonna say be too specific about the numbers, but it was thousands, and then like a whole gas pipeline network across Eastern North America. And Sci literally created like the whole digital twin, everything geocoded already. Then it ran over the whole portfolio physical risk analysis, because that's actually what the executives asked for. The risk manager and the insurance manager, they're in charge. And what it did, it analyzed overall, like again, like huge across states assets, analyzed it for physical risk, everything across. Tornado is in that area, like quite significant, right? Winter freeze, hurricanes, anything that you can think of, wildfires, all of it. And it identified directly, okay, from this overall portfolio, what are the key assets we should actually focus on? What is also like a little bit like the bet that you take here? What are actually the risks that you that are going to be a little bit more challenging to mitigate directly, because you have some accumulation risk. You're not like having plants here and in Japan, and you can geographically diversify. And then really also going deeper into, hey, what are the most critical nodes in the system that you actually should also like focus on with regards to the negotiations, and bring things up with regards to risk controls and stuff like that and so on, if they actually did their job on the other side. I just like, it was super exciting to see the risk manager providing massive value to the executive and just being able to answer questions also ad hoc, right? Like, so for example, for business interruption, we definitely have to look at that node, because this actually, if this goes down, half of the system goes down, right? So already planning while doing the acquisition what they have to do from a risk management perspective to make this an even better deal. And I think that was just like super exciting and amazing, and we had great feedback.
Yeah, and what was like you don't feel it until you see it, but seeing the map of the assets with like tornado paths and the hailstorms and the forest fires in the proximity, like it really puts things in the perspective.
Exactly, it makes it tangible, right? And then again, it takes away all this friction. Normally, you would have gone like giving it to I don't know, like a certain project where it takes months or weeks or whatsoever, and here one person, right, can do that on publicly available data, or data that actually Sci can actually find from its own proprietary sources, and just like build that up like in minutes, hours, and have like an analysis that took us always months, now in a day, 2 days.
Yeah, I mean, it's we live in an amazing.
Yeah, now I think like it's
time.
the time of the risk management function where it gets very excited to massively provide value into the overall company, right? Because now you have the leverage. Before, okay, you had like all of these basic minimal compliance stuff that you have to do, then some risk registers and stuff like that. But now you get like the firing power to like, hey, I can help you guys here, I can help you guys here, and I think that's gonna be an amazing.
Yeah. That I mean. I don't think you understand just how big this is, because one of the challenges risk professionals and insurance professionals have is they kind of, even the people that want to support decisions, the reality of corporate decision making is that nothing is kind of finalized until like half an hour before the actual decision time. And until the very last second, the investment team is trying to adjust the numbers. The finance team is trying to run some scenarios to see if the deal makes sense or not. So there's usually like a very small window to conduct any kind of additional risk analysis or stress testing on top of it. And in the past, it was challenging because you had to read it and manually run the analysis. And I mean, back in my private equity days, running a simulation on an investment model would take like 24 hours of just pure compute. And in the middle of the night, it would break, and then in the morning, you would have to restart for like another 24 hours. And it broke like frequently. So all of that took ages. Now it takes minutes. And you can literally receive once you create a digital twin for the asset, you can receive a question and almost instantaneously conduct the analysis and kind of come back with some insightful response that helps the company to make a trade-off.
Exactly. No, that's brilliant.
So we live in exciting times. Last week we talked about submissions, and I promised that we would make the submission checklist available on the website. So we've now finalized it. It looks good. The designers had a go at it. It's a useful checklist that I use in my work, trying to make sure that I properly communicate our risk profile to the underwriters. Look out for it on ScyAI page on LinkedIn, because we'll just make the link to download it for free available there, and it will kind of circulate each week. So if you missed it once, you'll see it again, because it's a valuable piece of knowledge. All right. Any final thoughts? Any idea? Any other messages?
No, all good. I'm excited that the people get like a hold of the checklist that you have been working on, that you just mentioned, the PDBI checklist. Maybe we can also add it in the comments somewhere, a first link, right?
Oh, yes, good idea. We will.
And then, yeah, I'm excited to talk to you again, Alex, I think next week, right?
In 2 weeks' time, yeah.
2 weeks. Ah, yeah, exactly. No, I'm gonna be sailing in 2 weeks. We have to move that one.
Okay, so then next week it is. There you go. Although a podcast from Croatian boat is not the worst thing that
I have to bring my Starlink. Yeah, we'll check. I have it.
No, next week is fine. Next week is fine.
Brilliant.
All right, thanks. See you soon.
Ciao, ciao.
All right.